Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Baxter International was founded in Deerfield, Illinois in 1931. It pioneered the commercial kidney dialysis machine in 1956 and built a portfolio of essential hospital products that patients and clinicians depend on daily.
The core product set is not glamorous, but is indispensable. IV solutions hang in virtually every hospital room. Infusion pumps deliver medications precisely. Peritoneal dialysis supplies keep kidney failure patients alive at home.
IV solutions manufacturing is a structural moat. Building an FDA-compliant production facility requires hundreds of millions in capital and years of regulatory approval. The manufacturing complexity creates a high-barrier, limited supplier market.
The peritoneal dialysis franchise is Baxter's most globally distinctive asset. Unlike hemodialysis requiring clinic visits 3 times per week, peritoneal dialysis patients self-administer treatment at home daily, and Baxter supplies everything they need.
The Hillrom acquisition added smart beds, nurse call systems, and patient monitoring. Integration has been challenging, but the combined portfolio strengthens Baxter's position within hospital procurement.
Hurricane Helene in late 2024 severely damaged Baxter's North Carolina manufacturing facility, creating a supply disruption in U.S. IV solutions that drew national attention. The recovery timeline became a critical watch item for investors.
That supply disruption highlighted both the fragility and the market position. Hospitals scrambled to find alternative IV solution sources, confirming that Baxter's U.S. manufacturing capacity has very limited competition from domestic producers.
Operating margins around 8% are depressed versus historical levels. Integration costs, supply disruption, and input cost pressures have suppressed earnings, creating the core recovery narrative for investors.
On the competitive radar, Baxter is benchmarked against Becton Dickinson, Medtronic, and Abbott. Those peers have stronger margins and faster growth. The comparison highlights the operational recovery still required at Baxter.
Joe Roman became CEO in 2023. His priorities are operational simplification, margin recovery, and evaluating which business units fit the long-term portfolio strategy. A potential kidney care separation has been publicly discussed.
The dividend was cut in 2023 as the company navigated financial pressures, a rare event for a large-cap healthcare company, underscoring the operational challenges Baxter faced across multiple simultaneous disruptions.
Serving over 100 countries and 65,000 healthcare facilities, Baxter has genuine global scale. The international dialysis business serves markets where home dialysis adoption is still in early stages.
The long-term thesis for Baxter is a turnaround story. Structural demand for IV solutions and dialysis is non-discretionary, the manufacturing moat is real, and management's execution on margin recovery is the key variable to watch.
Kidney disease is a growing global burden driven by aging populations, diabetes prevalence, and hypertension, ensuring that Baxter's dialysis franchise has multi-decade structural demand regardless of near-term operational headwinds.
That's the company chapter for Baxter International. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
When a patient is admitted to a hospital, within hours they are almost certainly connected to an IV line, a bag of saline or dextrose or a medication drip hanging from a pole beside the bed. That bag almost certainly came from Baxter International. Baxter makes the products that hospitals literally cannot function without: IV fluids, nutrition products, surgical consumables, and medication delivery systems. It is an unglamorous but deeply essential business, and in the first quarter of 2026, Baxter delivered a genuine earnings beat, 16% above consensus estimates. Today we are breaking down a company in the middle of a significant restructuring, shedding non-core businesses, paying down a heavy debt load, and trying to prove that the hospital products franchise at its core is worth meaningfully more than the current stock price implies. This is Charged Alpha.
Baxter International, ticker BAX, is a Deerfield, Illinois-based healthcare company with a long history as a provider of critical hospital and renal care products. The company underwent a highly transformative period over the past several years. First, the massive $11 billion acquisition of Hillrom, a hospital beds and patient monitoring company, then the subsequent spin-off of its kidney care division as a separate public company called Vantive. That Vantive spin-off was completed in 2024. The Baxter that remains today is a more focused enterprise: IV solutions, hospital nutrition products, infusion pumps, surgical consumables, and medication delivery systems. These are essential, high-volume categories that hospitals depend on every single day. The company carries a market cap of approximately $8.9 billion. Revenue for the first quarter of 2026 was $2,615 million.
First quarter 2026 results: revenue of $2,615 million, earnings per share of 36 cents actual versus the consensus estimate of 31 cents, a beat of 16%. That is a meaningful outperformance. After a period of considerable earnings volatility tied to the Hillrom integration challenges and the severe IV bag supply disruption caused by Hurricane Helene flooding the North Carolina plant in 2024, a clean 16% beat gives management real credibility heading into the remainder of the year. The North Carolina IV manufacturing facility has ramped back toward full capacity, addressing what had become a nationally reported IV fluid shortage in U.S. hospitals. Management indicated that the plant recovery and pricing improvements across the hospital products portfolio were the two primary drivers behind the upside in the first quarter, and both trends appeared durable going into the second quarter.
On the income statement, $2,615 million in quarterly revenue reflects the new post-Vantive Baxter, a smaller company by revenue than its predecessor, but theoretically one with higher margin potential now that the lower margin renal business has been separated out. Gross margins for the remaining Baxter should benefit over time from this structural mix shift, though the significant debt load from the Hillrom acquisition continues to weigh heavily on net income through interest expense. Operating expenses have been a focus area, with restructuring charges related to both the Hillrom integration and the Vantive separation flowing through the income statement periodically. The 36 cents of earnings per share, while above estimates, still reflects a business in genuine transition. Revenue growth is modest, given the consumable and replacement demand nature of most products, but pricing has been a meaningful positive contributor to margin in recent quarters, and management expects that to continue.
The signature metric I want to highlight for Baxter is IV solution market share and manufacturing capacity utilization. This sounds technical, but it has profound strategic significance. During Hurricane Helene in 2024, Baxter's North Carolina plant, one of the largest IV bag manufacturing facilities in the entire United States, was flooded and temporarily taken offline. Hospitals across the country faced serious rationing of IV fluids, surgical procedures were postponed across multiple systems, and the fragility of the U.S. IV supply chain became front-page news nationally. Baxter's response, aggressively ramping the plant back to full capacity and engaging with policymakers about the importance of domestic manufacturing of essential medical supplies, was actually a strategic inflection point. It reinforced Baxter's role as critical healthcare infrastructure, strengthened its relationships with hospital procurement teams, and created a narrative of resilience that competitors cannot easily replicate.
On the balance sheet, this is where the Baxter story gets genuinely more complicated. The Hillrom acquisition was financed with substantial debt. The company took on more than $15 billion in total debt at the time of the deal, which the market widely viewed as an overpayment from the start. While the Vantive spin-off helped reduce leverage by separating some associated obligations, Baxter's remaining balance sheet still carries a meaningful debt load relative to its current earnings and cash flow generation capacity. Free cash flow is the metric that matters most here. Management's demonstrated ability to reduce that debt over the next several years will determine whether this restructuring story ultimately succeeds. Capital expenditures for the IV manufacturing business are real, particularly as Baxter invests in the North Carolina plant and explores potential capacity expansions to address domestic supply resilience. Debt reduction progress each quarter will be the signal investors watch most carefully.
Capital returns at Baxter are currently quite limited by the debt situation, and that is entirely appropriate financial discipline. The dividend exists and is being maintained, but it has not been a priority for growth relative to debt reduction, and share repurchases are minimal at this stage of the restructuring. A company with Baxter's current leverage profile should be directing available free cash flow toward paying down debt rather than returning capital to shareholders through aggressive buybacks or a rapidly rising dividend. The good news is structural. As the leverage comes down over the next 2 to 3 years, the capacity for meaningful capital returns expands considerably. Investors buying Baxter at $30 today are not buying a dividend growth story. They are buying a restructuring and deleveraging story, a bet that the core hospital products franchise generates enough free cash flow to retire debt, improve margins, and eventually reach normalized earnings power that justifies a materially higher stock price.
Management's key near-term catalysts center on 3 interconnected themes. First, the continued ramp of the North Carolina 4 manufacturing plant, which should restore volumes fully and improve segment margins as capacity utilization increases back toward pre-Helene levels over the coming quarters. Second, pricing improvements across the broader hospital products portfolio. Management has indicated that long-term contract renegotiations and cost pass-throughs in an inflationary input environment are progressing constructively with hospital system procurement teams. Third, the ongoing restructuring program aimed at simplifying the organizational structure, reducing overhead costs, and capturing synergies that were originally projected for the Hillrom deal, but have not yet been fully realized. Management has also highlighted the regulatory approval pathway for next-generation infusion pump and smart medication delivery platforms, which carry structurally higher margins than the basic consumable business. The consensus analyst price target of $32 implies modest but real upside from current levels if execution holds through the year.
Analyst consensus on Baxter sits at hold following the quarter. The 16% earnings beat was positive, and some analysts have specifically noted improving operating momentum as a reason for cautious optimism. But the debt load and the multi-year execution risk on the restructuring keep most sell-side firms from moving to a conviction buy rating. Price targets cluster around $32 from the current level of approximately $30, implying roughly 6 to 7% upside to the average target. The bull case for an upgrade to buy would require visible and consistent evidence of accelerating debt reduction, expanding operating margins in the core hospital products business, and successful launch of the next-generation infusion pump product line. Bears point to the risk that hospital system budget pressures limit pricing power, generic competition erodes consumable margins over time, and the debt burden constrains strategic flexibility if a macro slowdown pressures hospital volumes. One strong quarter does not resolve a multi-year restructuring.
On valuation, Baxter at $30 is priced as a restructuring story with meaningful execution risk rather than as a normalized compounder of cash flow. The price-to-earnings multiple reflects elevated uncertainty about the trajectory of margins and normalized earnings power over the next 2 to 3 years of transformation. If management successfully executes the restructuring, reducing debt, expanding operating margins, and returning the core hospital products business to steady organic growth, the stock could re-rate considerably from current levels. The central valuation question is what normalized earnings power looks like once interest expense comes down meaningfully and one-time restructuring charges roll off the income statement. The hospital products franchise, evaluated in isolation, is a high-quality, essential demand business that would command a premium multiple if owned by a more financially clean company. The challenge is that this value is currently obscured by debt, restructuring noise, and the shadow of the Hillrom deal perception. Successful deleverage unlocks embedded value.
Bull case number 1. The IV bag shortage elevated Baxter's strategic importance in ways that create durable competitive advantage going forward. When the North Carolina plant went offline after Hurricane Helene, hospitals discovered just how dependent they were on a single essential supplier for critical fluids they use in enormous quantities every day. That event accelerated serious conversations at the national policy level about domestic supply chain resilience in healthcare manufacturing. Baxter is now investing in capacity at precisely the time when lawmakers and hospital procurement officers are actively interested in strengthening domestic production of essential medical supplies. This creates a potential path to favorable, long-term purchasing agreements, preferred supplier status with large health system groups, and possible government support for domestic manufacturing, all of which would structurally improve Baxter's competitive positioning and pricing power versus foreign-sourced or generic alternatives over the long term.
Bull case number 2. The Vantive spin-off makes Baxter structurally cleaner and ultimately more valuable than the combined company was as a conglomerate. Kidney care, dialysis equipment, peritoneal dialysis solutions, and related renal products is a lower margin, more capital-intensive, and slower growth business than hospital IV fluids and medication delivery systems. By separating Vantive as a standalone public company, Baxter management effectively freed the core hospital products franchise from the financial and operational drag of a fundamentally different business with a different growth profile and capital intensity. The remaining Baxter has better margin potential, a more focused management team, and a product portfolio that is less capital-intensive to sustain and grow. Investors who believe the conglomerate structure was obscuring value in the higher-quality core business may be correct. The sum of the separated parts may ultimately prove greater than the combined whole was trading for at its worst.
Bull case number 3. Hospital budget cycles are gradually turning more favorable after a difficult post-pandemic adjustment period, and that creates a natural tailwind for Baxter's capital equipment business. After a period of intense cost pressure in the immediate post-pandemic years, driven by labor cost inflation, supply chain disruptions, and procedure volume normalization, hospital systems in many major markets are showing meaningfully improving financial health. A financially healthier hospital customer base means greater openness to approving capital equipment purchases for next-generation infusion pumps and smart medication delivery systems, less aggressive pressure to reduce consumable volumes or demand steep pricing discounts, and more willingness to engage in value-based contracts that reward preferred supplier relationships. If hospital capital budgets continue recovering through 2026 and 2027, Baxter's higher-margin capital equipment categories could see accelerating demand that generates meaningful operating leverage on top of the consumable revenue base.
Bear case number 1. The debt burden inherited from the Hillrom acquisition is a multi-year anchor on financial performance and shareholder returns that the market has not forgotten and may not forgive quickly. More than $15 billion of debt taken on at interest rates that have been elevated for several years means a substantial portion of operating cash flow goes directly to interest expense rather than to reinvestment in the business. Debt principal reduction or capital returns to shareholders. If the deleveraging process takes longer than management projects due to slower than expected earnings growth, higher than expected restructuring costs, or capital expenditure requirements for manufacturing, the timeline to normalized free cash flow extends meaningfully. In a higher for longer interest rate environment, refinancing of maturing debt at current market rates adds incremental pressure. The Hillrom deal was widely viewed as an overpayment at announcement, and the market will continue discounting the stock for the consequences of that decision until leverage visibly and sustainably comes down.
Bear case number 2. Slow organic revenue growth limits the ceiling of any restructuring success scenario. Baxter's core hospital products business, IV bags, nutritional products, surgical consumables, is not a high-growth category by any realistic assessment. Hospital procedure volumes grow roughly in line with underlying population demographics and procedure utilization trends, which are moderate at best. Pricing improvements can help at the margin, But the core business is unlikely to generate top-line revenue growth rates that would excite growth-oriented investors or justify a significant multiple expansion on their own. That means the entire bull case depends on margin expansion and debt reduction rather than revenue acceleration, both of which take time and carry substantial execution risk. If generic competition intensifies in any of the core consumable categories, or if hospital systems push back harder on pricing, the margin improvement story deteriorates quickly and leaves the investment thesis without a durable foundation.
Bottom line on Baxter International, the first quarter beat of 16% against consensus estimates was a genuine positive development, and it demonstrates that the core hospital products business has real and meaningful earnings power when it is not disrupted by external events, natural disasters, or heavy restructuring noise. The IV plant recovery, pricing improvements across the portfolio, and the cleaner corporate structure following the Vantive spin-off are all moving constructively in the right direction. The challenge that keeps this a hold story rather than a buy is the debt load inherited from Hillrom, which constrains financial flexibility and weighs on current earnings. At $30 with a consensus target of $32, the near-term upside is modest, but the multi-year path is more interesting if management can demonstrate consistent deleveraging and margin expansion over the next several quarters. This is a show-me story in every sense of the phrase. The market needs to see evidence, not promises, before it will reward the stock with a more constructive valuation. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall